Volatility is like a virus. It's like a virus that infects your portfolio and damages your long-term returns. And I can illustrate how volatility impacts your portfolio in the following example. So in this example, I have a theoretical $1 million investment. And the $1 million can be put in one of two portfolios. They both, over 4 years, have 2 round trips. The high volatility portfolio goes down 30% in year 1, up 30% in year 2, down 30% in year 3, and back up 30% in year 4. The low volatility portfolio, true to its name, has the same round trips but with much less severe magnitude or swings. But despite the fact that they have the same sum of returns of 0 over 4 years, they have markedly different values at the end of year 4. The high volatility portfolio, your $1 million investment at the end of year 4, is only worth $828,100. In other words, you've had a loss on your $1 million investment of over $171,000. The low volatility portfolio, despite having the same sum of returns, has a value of $995,000, so a loss of approximately only $5,000. So same sum of returns, but wildly different values at the end of year 4, with the low volatility portfolio have a much better result, or certainly a much less worse result. So why is that? It's because of the way compounding works. If you look at the chart, after a 30% loss for the high volatility portfolio, a 30% subsequent gain does not erase the 30% loss. So after a 30% loss, $1 million is down to $700,000. Then after the 30% recovery in year 2, you're at $910,000. So you've still suffered a $90,000 loss. So a 30% gain doesn't wipe out or anywhere near wipe out a 30% loss. Now let's look at the low volatility portfolio. After a 5% loss, the $1 million investment is worth $950,000. After the 5% gain, it's back to $997,000, so only a $2,500 loss. So you can see how volatility, even though with the same sum of returns, how volatility is like a virus that really is detrimental to your portfolio. I want to point out one more aspect of how volatility can really be detrimental to your financial health. In this example, I want to point out how one large loss can wipe out several good years. So in this case, I have a 5-year example, again based on a $1 million investment. But in this case, instead of having round trips of down, up, you have 4 good years, a bull market of 4 years, followed by a bear market in the 5th year. So looking at the high volatility portfolio, in the 4 good years, the first 4 years, it gains 15% each year. So pretty good, 15% each year. You know, the sum of returns is 60%. In the bear market year, in year 5, it gets killed. It has a 48% loss. So its sum of returns is 12%. Now let's look at the low volatility portfolio. True to form, in the 4 good years, instead of being up 15% each year, it's up only 5%. So after 4 years, you've got a sum of returns of only 20% as opposed to 60%. Now, true to its character again, in the bear market, in year 5, instead of losing 48%, it loses 15%. So it has a sum of returns of 5% compared to the 12% for the high volatility portfolio. Now let's go to the actual dollars again. The high volatility portfolio is in a loss position. At the end of year 5, with a sum of returns of 12%, it's worth about $910,000. So you still have a loss of approximately $90,000. The low volatility portfolio that only went up 5% a year in the good times in the first 4 years is still in a winning position with a gain of $33,000. It's worth $1,033,000 at the end of year 5. So you can see that with the high volatility, one large loss can wipe out years of gains, whereas the low volatility portfolio is much less exposed to that phenomenon. And we know that happens. Bear markets have happened, and they will happen. I'm pretty sure they're going to happen a few times again in our lifetimes. So you can see how risk management, specifically mitigating volatility and avoiding large losses in bear markets, is essential to achieving superior long-term returns. At Outcome, that lies at the foundation of how we invest. We use machine learning-driven, data-based investment models to mitigate volatility, avoid large losses, so that our clients can achieve superior long-term results. Thanks for watching. If you want to learn more about outcome metric asset management and our investment strategies, please visit our website at outcomewm.com, where you can receive our contact information and sign up for our monthly newsletter.